I have 6 key points to irrevocable life insurance trust. Hi, I'm Bob DePasquale from Initiate Impact Virtual Family Offices, and today we're talking about ILITs, or Irrevocable Life Insurance Trust. Now, we've talked about trust before, but we want to dive deep on this type today. Check our video about estate taxes for more information, but ILITs are designed to remove life insurance policies from your estate. It's income tax-free to the beneficiaries, but not necessarily estate tax-free. So if you're over the estate tax exemption, then you might want to consider using an ILIT to remove it from your estate. When considering there could be an upwards of 40% savings on your estate taxes, this is a pretty important transaction to consider. There's 2 ways to set it up. You can take an existing insurance policy and transfer it into an ILIT, or you can have an ILIT purchase insurance on yourself. An important rule is if you do the transferring method, it must be there for 3 years prior to your passing. If not, the benefits are reversed. This rule does not apply if the insurance policy is purchased by the trust originally. The second key point is that it must be irrevocable. So you cannot have any incidents of ownership, nor can you be the trustee. You can assign a trustee to be a friend, a relative, or even a financial institution. The third key point is gift taxes. In 2023, the gift tax exemption is $17,000. So you can put premiums into the policy that's owned by the ILIT and exempt those as gifts to the beneficiaries. Now, there's multiple beneficiaries. There could be some complications there. You want to figure out if there are any other gifts going on and make sure you stay under that $17,000 if that's important. In order for the gift to be considered of present interest, the trustee of the ILIT must send a letter or some kind of communication to the beneficiaries and let them know that those premiums or gifts have been made. They do have the option to take them out. This is called a crummy power. Most irrevocable trusts cannot be dissolved. And this is key because if your situation changes or your strategy is different and you decide to let that policy lapse, you might have an empty vessel at your death. The fifth point is that these type of trusts can be funded or unfunded. If it's just the insurance policy, then it's considered unfunded. And there can also be other assets in there. If that's the case, then it would be a funded trust. An example of an asset in there could just be cash to pay the premiums. And finally, the sixth point is that ILITs provide asset protection. The assets inside of these trusts are protected against divorce, bankruptcy, and any other creditors. ILITs are clearly a complicated vehicle with a lot of rules that you need to abide by, otherwise there'll be no benefits. So make sure you consult a professional, and we're always here to answer questions. But if you're looking to minimize estate taxes, that could be a good option for you. I'm Bob DePasquale from Initiate Impact Virtual Family Offices, wishing you a generous rest of your day.